Work from home, online shopping, all the ways our lives changed in the past couple of years did weigh on office and retail real estate in recent years. But our guest today says both segments showing some strength in today's environment. Joining us now to discuss, Colin Lynch, Managing Director and Head of Alternative Investments with TD Asset Management. Colin, always good to have you on the show. Excited to have you back.
Well, I'm excited to be here again. Thank you for having me.
All right, so interesting things always in the real estate space. We have preconceived notions about how our lives have changed in the last several years, what it means for real estate. I want to start with office, because office has struggled for a long time. Are there any green shoots?
Yeah, you're exactly right. Office has struggled for some time. But interestingly, we are seeing some green shoots, particularly when you look at what we call the fundamentals. So what is leasing? How much leasing is being done? Are tenants taking more space? What rents are they paying? On those questions, we are seeing better answers today than we've seen in the last 5 years. We are also seeing those answers over the course of 2024. Important to note, those better answers are concentrated in some of the highest quality buildings. So we're still seeing that flight to quality, which makes a lot of sense. If you have the opportunity to upgrade your space, to move into newer space, better located space, closer to transit, higher ESG environmental considerations involved space, then you'll take that opportunity. But what's new, I think, is the return to office mandates have begun working themselves through the system. And so when it comes to now tenants looking at their offices on those in-office days, we're seeing a growing number of tenants saying, I actually need a bit more space. And so we're seeing some tenants beginning to take incremental adds to the space needs that they had, and you sum all of that up, and we're seeing more leasing across the portfolios in Canada, especially, but also in some cases internationally as well. So certainly some more optimism in the office space, more optimism than we see, I am sure, in the last 3 to 4 years, but importantly concentrated in that highest quality office space.
More people back in the office, less seats for me on my morning commute, but that is my problem and not the market's problem. Retail's been interesting, right? Because I mean, obviously there was a big push for online shopping, but I know in discussions you and I have had, retail's held up pretty well.
That's right. And you go back 4 or 5 years, and the discussion was all about death of retail. We'd sit at home, we'd order everything online, and we'd wait for those packages to arrive. And as we came out of the pandemic, what was interesting was that people began really looking forward to those in-person experiences. And we saw right in 22, 23, people were staying longer, shopping more, their bags were heavier. And that has continued today. And so when you look at performance, what are your returns by asset class in real estate in Canada, you know, the trick question is, what was the best returning major property type last year? It was retail. Oh. And that is driven by some of those fundamentals that we were talking about in 23 and 24. We saw volumes recover very nicely. We saw shopping baskets fuller. And throughout the pandemic, as you know, we talked about the different types of retail. You had essential retail, which are grocery stores and, you know, bank branches and pharmacies, where we learned we have to go shop to eat and to do the basic essentials of life. And those have performed very, very well throughout the pandemic and beyond. And investors have realized that. And you have seen good returns experienced in those sectors. But we are also now seeing some of the more discretionary retail perform quite well. And so whether that's Main Street retail on major nodes, like in Toronto on Bloor Street, or whether that is in other formats such as enclosed shopping centers, which really were challenged, they have begun bouncing back. Not all of them, but a number of them have begun bouncing back. So retail's performed quite well, and that would be a surprise, I think, to a lot of folks that were looking at the space 2 to 3 to 4 years ago.
Is that success of brick and mortars retail coming at the expense of industrials and warehouses?
That's a great question. Short answer is not really. So how does that work? Well, effectively, we have had a moderately to robustly, depending on where you're looking in the world, growing economy, and that manifests itself into more purchases. And retail versus industrial, if you look at industrial, the part of industrial that serves those purchases is called logistics. So when you buy, you can buy in person or online. But if the economy is growing, people are spending more, you can actually have both sectors win. So that has been happening in 2024. Certainly, we saw good strength in both sectors. What's happened in 2025? Some questions around the broader macroeconomic, geopolitical, tariff-influenced environment. And that has created a bit of an air pocket for the industrial sector. So not as strong as it was 3 years ago, 4 years ago. Certainly the fundamentals, so i.e. what's the vacancy, still pretty healthy, increasing, but pretty healthy. What's the rents? Well, they're 3 times higher market rents than they were 4 to 5 years ago, but they're no longer increasing. And in some cases, they're decreasing. And so you step back and you say, is that sector still strong? Generally. Does it make sense to have all your chips in that one sector bucket? Probably not, but it didn't make sense 3 years ago. So we do think diversification really matters, and this is an instance, whether it's geopolitical uncertainty, and the tariff environment, where we say, yeah, it's interesting, it is a relevant sector, but so are all the other sectors in real estate as well.
We got to get to the residential part of that bucket. Obviously, this has been an interesting space because we're told we have a shortage of homes, but we also know we're cutting back on the welcoming of the number of new Canadians we're welcoming. How does that play out?
Yeah, that's right. And I'd say those two pieces are related to each other in terms of the changes to the immigration policies were certainly influenced by the notion of a housing shortage. I would just add, we have to be very clear on where precisely this shortage is. The shortage is in affordable housing. Where the shortage does not exist, I would argue where a surplus of housing exists, is in luxury accommodations. And so where do we see luxury accommodations? Certainly a lot of the condominium units that were sold and are being constructed right now in Toronto, in Vancouver, for instance. And over the course of this year in Toronto alone, we'll have tens of thousands of new condominium units delivered. And as you look at that market, you're seeing price declines, you're seeing higher vacancy. But on the other hand, if you look at some of the more affordable apartments, you see extremely low vacancy and tremendous demand. And then if you go further and you look at social housing, you see tremendous wait lists and no vacancy. And so when we talk about a housing crisis, which is true, we are in one, we have to define where that housing crisis exists, which is in affordable housing. And if you have the privilege of serving that sector as we do by providing, in many instances, affordable housing for Canadians, and we have housing outside of Canada as well, what we have seen is consistently low vacancy. We've seen actually turnover drop because people want to stay in their units, but we've been also able to accomplish rental growth because we have provided good spaces for people to live in.
Now, real estate, big part of your focus. Obviously, we've been talking about, you're also looking of, obviously, an alternative. There's been a lot of talk about that in this kind of environment. A lot of uncertainty, too, going on there. I mean, how do you sit back and watch what happened? I think even the past 6 weeks, the roller coaster ride we've been on.
That's a good question. So certainly alternatives, I like to call it the private market. So these are non-publicly traded investments. And I've been asked how I feel. And I respond by saying I've been very calm and tranquil. And why do I say that? Because at the end of the day, our job is to understand, has something changed? Mm-hmm. And if it has changed, our job is to get ahead of the market and implement changes to portfolios so that we can build and grow income long term and we can achieve exceptional performance. So the question is, through all the turbulence and all the volatility and all the announcements, what has fundamentally changed? So in the infrastructure space, for instance, a lot of questions about the environmental side of things, and particularly green energy, renewable energy, and the relevancy of that. I'd step back and say, our power needs as a global society will nearly double by 2050. And so how will we be able to produce and supply that amount of energy? Renewable energy will be part of that answer. As we look at trade, whether it's consumption or production of goods, that we have had ports since the beginning of civilization, and will continue to have ports over the long term. And they will continue to import a variety of goods, not just consumer goods, but manufacturing goods, goods demanded by governments in a variety of different forms, think defense. And so they will continue to be relevant long term. Now, does that volatility produce buying opportunities? Absolutely. And so we're constantly on the lookout for those. Does that volatility create long-term shifts in the potential thereof? Absolutely. So we're always evaluating that. But our job is to not get transfixed by the short term. Our job is really to understand what is the impact long term and position portfolios accordingly.